Hi, I'm Amber Hestla, and we're back with another in-depth look at some of the information we shared in our daily e-letter. We cover a lot each week, and you can subscribe to the e-letter. The link is in the bio. You can also subscribe to this channel or post comments below the video. So last week was our first weekly video, and we did hear from a few of you with some questions. So today I'm going to hand it over to Mike to answer those questions. He shared some charts showing that day-to-day moves in stocks are almost a 50-50 breakout. So I just want to get some more details. Mike, is that in bull markets, bear markets? Does it apply to meme stocks?
Yeah, those were some of the questions that we did get from readers or I'm sorry, from viewers. I guess this is a video. So it was from viewers. And I just wanted to step back, show some PowerPoints, and dig into this in a little bit more detail. The idea here is day-to-day changes are basically a 50-50 proposition. This is a chart showing Apple's frequency distribution since Apple began trading. And Apple closed up 52.8% of all of the trading days. So that's basically 50-50. Now, in the last 12 months, the S&P 500 SPY, the tradable ETF, down 50.3% of all trading days. And then I dug a little bit deeper. The biggest loser in the S&P 500 is MRNA, Moderna, and it's down 56% of the time in its last 70%. Oxy, the biggest winner, up 51% of the time. So generally, we see a range between 45 and 55, a little bit on the extremes at times. But right now, 90% of the stocks in the S&P 500 have been up between 45 and 50% of the time, 55% of the time. Average and median were both 49.2. So this is a fairly predictable pattern. The largest deviations were CVX, which was up 57.8% of the time, and Align down 60% of the time. Even the deviations aren't as dramatic as you might expect. In bull markets, we saw that, and all I did was look at the bull market, the most recent bull market from beginning to end, and SPY was up 59% of the time. So then I used a similar time frame, went back to 2009, and it was up 57% of the time. So now we're starting to see how this information is useful. It's a 50-50 proposition day to day. But so that's where you're starting at. If you can find an edge there, you can use this as a trading strategy. What we see here, the earliest days of a bull market have a significant bullish edge. So what we can do now is track on a rolling basis, maybe over the last 100 days, what's our up-down ratio? And when we see a strong tilt to the upside, that's the beginning of the bull market confirmed. That can be important to trade. Bear markets, between the beginning of the bear market, which was just the beginning of this year, to now, S&P up 45% of the time. October 2007 to March 2009, also a very deep, very fast bear at times. S&P was up 49% of the time. So bear markets tend to be up less than 50% of all trading days. Again, rolling 100-day window, what's your up-down ratio? If you're under 50, you're probably in a bear market. So you can use this, again, to develop a trading strategy. Finally, I took a look at meme stocks because this seemed interesting. GME, in the last year, the stock is down almost 40%. This is GameStop, the original meme stock, if I'm correct, because I don't really trade meme stocks, but I think GameStop was first. The stock fell on 52% of the trading days and was up 48%. So we're at that 50-50 even in these meme stocks. I went back to the beginning of the meme idea, January 2021. GameStop up over 450%, down 53% of trading days, up 47. We see the exact same ratio since meme stocks began on AMC. And then in the past year, with the stock down 75%, we're at that 55-45 in favor of down days. So what we're seeing here is an awful lot of 50-50 trading ideas. Knowing that, we can create trading strategies that help us take advantage of this very idea. And that was basically what I had this week. Now, you looked at some other stuff this week, including some interesting ideas on how consumers are reacting to the recession. Did you want to talk a little bit about that?
Yeah, that's right. Actually, reliable transportation makes it easier to get to work, and New York Fed survey of consumer expectation shows that almost 9% of households with income under 50K are actually planning to buy a car in the next 4 months. And so that's up 7%, less than 7% at the end of last year. And this really comes as consumers are expecting to cut discretionary spending, according to the same survey. So this really might be a good time to just look at stocks with less expensive products like Walmart instead of those luxury goods makers like Tesla. So that's all we actually have this week, and we'll be back next week. Please remember to subscribe, like, and comment so we know what you want to see us cover next week.